Hey guys, welcome to another edition of the Trade Genius Podcast. Bob and Phil here as always. If you guys think this market is just fine and dandy because we've been ripping higher the last few weeks, we got something to show you. So let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So Bob, you had seen or showed me some charts here, and I thought it was pretty interesting because, as you know, devil's in the details, and I think you found some devilish details.
Yeah, so I guess the first chart I'm going to show you here, but this notion that we're, because the unemployment rate is low and a new bull market's on the horizon and we're going to pivot soon is just, it's just not realistic. And I'll show you another chart to tell you what's really happening, is that the consumer is dead. And I think he's broken dead. I don't think it's a simple matter of, he's retrenching or he's pausing. They basically squeezed all the juice out of the lemon and it's gone. You're down to the rind now. And even if inflation stops going up, Phil, as you know, it doesn't mean your cost of living is going down. It just means the rate of it going up has abated. And with the these layoffs that are roiling through the economy now, these are not low-income workers that are getting laid off, and they're not in low-cost states. I think what we're seeing here is basically recession on the horizon while the Fed is looking backwards at the wrong data. And while everybody here, on Twitter is going to debate me on market going higher, let me show you what Wall Street's doing. Wall Street's saying, "Sold to you, sucker." You know that phrase, you're sitting at a poker table and you look around the room and you're looking for the patsy. You can't find them, it's you. And so Wall Street generated through these use of these zero DTEs and another game they're playing too. It's just so the stuff is so complicated to explain to people, but the net effective is they're using derivatives for manipulation. So they're doing these everyday call options at the same time they're doing everyday selling puts, and they're not paying margin on these things, and so they make the market look bigger and better than it is, Phil. And when they stop, is that the market makers don't have to keep following the market higher. They turn around and they don't just go neutral. They turn around and they sell,
right?
And they create basically a tide washing out to sea, and that's what's happening here. And I just want to show you guys another chart. I think you already have it up. Is what happens. That's nice, Bob. You got the the insider buy sell ratio peaking. Well, it shows you when those ratios get big like this, and as after they get done selling their shares, look what the SPY has done, which is the main index. It falls every time.
Yeah.
And we're at this point. And the other thing too, today Carl Icahn made a huge put bet on for the 17th of February. The last time he put a bet on, he sold puts. I don't know if you remember that.
Yep.
And the market went straight up.
Yep.
So what we're looking at here, Phil, is we're looking at an incredible setup. And I think when these things happen, this is going to be like an elevator down. And this is why we're worried. We're not here, begging for a crash. I prefer not having one. But we're just pointing out to you is that they're running out of tricks. The patient they're running out of steroids and morphine and anything else to keep the patient alive, and it's going to get consumed. And this last chart I want to tell you is stunning. Okay, so we have interest rates now, the highest they've been in 40 years, short-term money. Well, guess who borrows short-term money? Corporations that don't make any money, and they use it to fund operations until they get enough of a runway in which they can cover their fixed cost and get a positive on their variable cost, and then that way they figure they could pay their notes off. And they've been doing it with 0 and 1% money for the last 3 years. Well, that's all changing, and so you have 45% of the Russell 2000 that don't make any money, Phil, and we have like 18% of the S&P 500 that is unprofitable. and we're talking on a cash basis. This isn't just games here. They got to go to the market and constantly get lines of credit and roll them and expand those until they can try to see if they can make it. And we're running headlong into a recession. And so I don't know how these companies make it. And look at what Bed Bath & Beyond did, right? They jammed their stock up, I don't know, what, 600%, and then they turn around and raise $1 billion in equity, on an equity sale, and it just wipes 60% of that move off in one day. And these moves happen overnight because they tend to announce them before the market opens. And I think that's what's going to happen here. You're going to start seeing companies that had these big run-ups are going to go and do what's called equity raising, which means that they're going to raise cash by giving away more shares, but they have to do it at a discount, and they use it then to firm up their balance sheet or to continue to try to outrun the Grim Reaper and try to turn cash flow positive. And I think we're running out of runway, and there's a lot of companies that aren't going to make it. And these are public companies, and as they go bust, as you know, Phil, they're going to affect the indexes. So I think I don't know what else to tell you guys to be worried, and I think this is beyond what's called the wall of worry, because the sentiment out there is not bearish. The sentiment's bullish. And so, we think that we owe it to you guys to share this information and to be very, very, very careful. That, I'll throw it back to you, Phil.
Sure. And if I would jump in, I would just say, just to wrap this up, is that in summary, Bob's showing you that consumer credit's on the rise, and we've shown you guys the credit card debts too, and the defaults are starting to rise. All of that's telling you that people are having to go back to credit. Some of it is overspending, sure. I think we're starting to see that segue into people just trying to pay bills, and so you're seeing tech doing a lot of layoffs, like Bob talked about. And what will happen here is that as liquidity comes out of the system, I know we keep talking about that, but it's really important because, if you zoom out on the chart, it's very clear that that's holding up the market. And we can show you, every time we show you that liquidity chart, it's going away. So there's an effort by the Fed, which the market's currently ignoring, to basically say, look, we're gonna throw a wet blanket on things because we need things to come down. In fact, today they were out again today, a bevy of Fed speakers saying that wage growth is too hot for 2% inflation, and telling you that the goal is 2% inflation. They're not flinching on that because they have an opportunity to say, well, we're going to try to get to 2%, but maybe we'll give it 3% and call it good. And they're emphatically saying, no, it's 2% and it's not going to change from 2%. So I think the market's largely ignoring what they're saying. I think Kashkari, he said the market's going to play chicken with the Fed and they're going to lose. And I think we're slowly probably seeing a turn here to that effect. So obviously this market is looking towards Tuesday CPI print, going to be hugely important, very volatile. But I think given what's going on the underlying, I think you have to go with the probabilities, and we got a big air gap below us. And this thing's been going up largely on just derivatives and short squeezes and gamma squeezes, which is all this market is turning into lately during the day, just a series of little gamma squeezes higher and higher. And it's unsustainable. And that's the same thing happened last August and a couple other times in 2022 when things got exuberant toward the highs. And it turns rather quickly, and sentiment changes rather quickly. And all of a sudden, Twitter's getting bearish again after they bought the dip incorrectly for the first three times. So you have to be careful here.
Yeah. And Phil, can you explain what a gamma squeeze is for those who may not be familiar with that term?
Yeah. So what happens is, think of gamma like it's just like a magnet sometimes that forms, and it's really based on how they're buying options. So sometimes you can buy options at different levels of price, and you can buy it at where price is currently trading at, or you can buy it where you think price is going, and that could be higher or lower depending on the direction of your bet, and that's called out of the money. Well, when a lot of people do that, it builds up leverage basically, and you create this like gamma fuel for that move to happen if enough people do it. And the reason is because if the dealers are selling you an option, then they're effectively taking the other side of that trade. So if a bunch of people are betting out of the money higher, they've now got to actually hedge that bet that they sold you because they're effectively short that move. And if too many people do it, they have to buy to hedge because they ultimately, at the end of the day, they want to be directionally neutral, but they can't be directionally neutral against a wave of out of the money buyers unless they actually are buying with them in a different capacity, whether that's buying futures or buying the underlying of the stock, because they're trying to maintain what we call delta neutral or just a neutral position. And at the end of the day, they make money on fees, commissions, the spread between the prices, and that's all they care about. And a lot of times in the market, you're going to see these moves, these sharp moves are because of those squeezes. The dealers don't care because they're neutral, but sometimes it's like it helps fuel the move. It's almost like a self-fulfilling prophecy. So without getting like super technical on the option Greeks, that's essentially what gamma squeezes are.
Yeah, and companies like Citadel, they know where people's stops are, they know where support and resistance levels are, and so they can manipulate by buying these out of the money calls at a very opportune time, like we saw yesterday with when Powell started to speak, the market went up inexplicably. And when he was done, it went down inexplicably. It's because people are making these bets. But it's like anything else, like a druggie, they have to get more and more and more drugs in their system in order for them to sustain these moves. And we're basically at a point where it becomes counterproductive. And at some point, I think, Phil, too, is that either the cost of making that bet becomes so high it becomes not worth it, or the dealers simply opt out and they won't even provide the fuel anymore because the risk is too great for them. They feel that they have an inability to hedge it correctly. Right. So these are things that people don't see, that really is the tail wagging the dog. And we're just trying to show you guys this data is available. You just have to watch for it. And the problem is that once it stops, just like the guy from Citibank said, you got to dance until it stops. When it stops, it doesn't go down the same way it went up. It just stops.
Right.
And you get these, like Phil said, these air gaps. So anyway, sorry for the long end of the convo, but I think these things are important for people to understand.
100%. Yeah, because it's so relative to how we trade, how the market trades now intraday. And it's broken a lot of things too. VIX, for the volatility you and I see during the day, it's right up there with the March 2020 COVID month of just disaster. But we're seeing those same 20, 40 point swings in a very short amount of time. It's very illiquid. And it's just another measuring stick of things not right under the hood in this market. And as you can see, like if you look at the chart in March 2020, things when they're in that condition unwind very, very, very quickly, and it's just boom, before you know it, you're down hundreds and hundreds of points in the indices. And then everybody was all of a sudden so bullish is just wondering what the heck happened. They all got smacked in the face. So it's very hard to tell people that when things are up like this and you're up near 4,200 and things don't look that bad. But if you're really looking at the breadcrumb trail, it's heading to the path of destruction. So it's just, got to be cognizant of that. So yeah, anyway, hopefully that helps you guys out. And like we've been saying, we're kind of on a bearish tilt here on our view. And I think the fireworks really start kicking off after CPI. And of course, if the technicals change and liquidity comes back in, then obviously we'll pivot on that view, but not looking that way at the moment. So just a word of caution again. So anyway, thanks for watching. We appreciate the views. Please hit like and subscribe. Thank you, Bob, for all of the data today. It was awesome.
Great. Thanks, Phil. Thanks, guys.
Bye.
Trade Genius.